If you've ever dreamed of living in paradise, maybe getting a second passport, possibly even saving on taxes, this is the video for you. Investment migration is the process where people can go and migrate to live in another country or live and work there by making an investment in that country. Or alternatively, it's where a country looks to incentivize foreign nationals to invest there by giving them the rights to live and work. These can typically be used by people for a variety of reasons. Often if you come from a country with a not very strong passport and you need to get visas to go every single place you want to go, you might find that having a passport from a stronger country would make your life a lot simpler to live and work and travel. So what's the difference between residence and citizenship by investment? Residence gives you the right to live in the country, whereas citizenship gives you the right to live in the country and enables you to carry the passport for that country. So there's a slightly different emphasis on each one. Residency is temporary, citizenship is permanent. So certain countries such as the United Arab Emirates will happily let foreign nationals become residents, but they're very, very strict about who gets citizenship. Conversely, other countries like some of the Caribbean islands are keen to attract investment and will allow people to become citizens and get a passport as part of their investment. These programs can be offered by all types of countries, whether it's a larger country in Western Europe looking to encourage investment into real estate or government securities and bonds, or it can be smaller countries looking to diversify their economies away from older industries towards tourism and leisure, and so encouraging people to invest in building hotel and resorts there. Each country's got their own reasons, their own way of doing it, and so you end up with a huge variety of different things, which means there's something for everyone. A lot of the reasons behind it come from trying to attract foreign investment, and particularly when the country's trying to change the nature of its economy. Sometimes they will encourage real estate investment to grow a certain area or a certain region. Other times when house prices go up too much, they may move away from real estate investment into something like financial investments, technological startups or government securities. It varies very much by country depending on which types of investment they're trying to incentivize and why. Each country has its own process, and the first step is to make sure that you qualify, and both in terms of have the appropriate amount of money to invest, but also that you meet their requirements to be a fit and proper person. Most countries are very cautious about who they let in, and particularly if they're going to be giving out a passport, so they want to be sure that they're not giving them to the kind of people that they don't think should be having them. So the initial stage is usually to make sure you qualify and to have some that you will pass their due diligence tests. Then it's looking at what type of investment it is and whether this is property, whether it's financial investment or securities, and making sure that you meet the requirements of when that investment's been made. Sometimes the investment has to be made before the application gets made. Sometimes the application gets made and then the investment has to follow within a certain amount of time. Changes by country. The amount of time it will take depends on the country and their approach to the speed of processing paperwork and the nature of the investment. Sometimes these things can take a matter of weeks, sometimes it can take months, and often for the bigger programs, bigger countries, particularly when citizenship is involved, if they're doing a decent amount of due diligence on the investor, it may take 6 or even 12 months. So you have to plan these things very much in advance. It's not something that can be done overnight. For the most up-to-date information, because these things change all the time, it's best to look on the Henley website, which is henleyglobal.com. So the question I get asked most commonly is, what is the difference between residency and tax residency? Residence by investment gives you the right to live in that country, but you're not obliged to be there all the time. In some countries, the ability to be resident there only requires you to be there a handful of days a year. To become tax resident somewhere usually requires you to have a more permanent attachment to the country, which is most commonly given by being there for more than 183 days in the year, which is half of 365 rounded up, or having your main home or family based there. So it's only when you meet those stricter criteria that you're likely to become tax resident, which means A, you pay tax in that country, but B, it's then easier to get out of being tax resident in the country that you're coming from. So when taking up a residency by investment, it's important to be clear whether you're actually intending to live there and wanting to live there and so concerned about the tax, or whether it's just an ability to go visit your holiday property or to have a plan B in case something happens in your country that requires you to leave in a hurry. And so If you're going just for the residency, maybe you don't need to worry about the tax. If you're looking at the tax, residency is a precondition for that. So they're two subtly different things, but there's a very, very big overlap. Most people are tax resident somewhere. And if you move to another country, you will typically stop being tax resident in the first country you leave and become tax resident in the one you've moved to. However, there are times when you've left the first country and not fully established yourself in the second, where you may fall between the gaps in definitions. So in theory, it's possible not to be tax resident but anywhere. But the practical aspects of making that work continually for a longer period get more and more difficult as you go. You need to stay on the road forever. But just because you're not tax resident doesn't mean you won't still be taxable on income sources that arise in that country. It's not all or nothing. In almost all cases, it's not possible to be tax resident somewhere without actually living there. Almost all cases, you have to be present in that country to become a tax resident, and that physical presence is the simplest way to establish that connection. Having a permanent home there is another one. Having your centre of vital interest, as tax treaties say, is the main determining criteria. And particularly when you get into deciding if you can be potentially tax resident in two places, your centre of vital interest is what determines which one you're more likely to be tax resident of. Every country has their own definition of tax residence, although they will be very, very, very similar in most cases. In the cases where someone is potentially tax resident in both countries under their own domestic laws, there are double taxation agreements which help to arbitrate the difference between the two. There are over 3,500 of these around the world, each of which is between a pair of countries, and there are a few regional ones for certain areas too. The main criteria for double taxation agreement in Article 4 residence, which says if you are a resident of one country and the other, how do you then determine which country you're ultimately going to be treated as being tax resident of? Because the country you're tax resident of is allowed to tax you on your worldwide income. The country where you're not resident is only allowed to tax you on the income that arises within that country. Usually demonstrating you're a tax resident is relatively straightforward because you are filing a tax return and paying the tax. Most authorities assume that you wouldn't be paying the tax unless you really wanted to or that you knew you had to. If you are claiming that you're a tax resident of a different country, that's a more complicated area. Most countries will issue tax residents with a certificate of tax residence, or TRC, tax residency certificate, and you need to have a TRC often to show the other country that you're not tax resident there, and the TRC gets issued under the terms of the double taxation agreement, and you use the TRC from country 2 to go back to country 1 and say, I'm a non-resident here because the other country considers me as a resident. So the general convention is most countries will accept the other country's tax residence certificate unless they have very, very strong reason to believe otherwise. So the key issue between residents and non-residents is whether you're taxed on a global basis or on a source basis. Every single type of income you have has a source somewhere, whether it's rental income, bank interest, dividends, employment, self-employment, capital gains, pensions, anything has a source. And the country of source usually has the first right to tax it. Now, everybody should have a tax residence, and the country in which they're tax resident also has the right to tax their worldwide income. So it's not difficult to see that if you've got multiple countries where you've got sources of income, all of those countries will tax it first, and the country of residence will come along afterwards and sweep up at the end and try and tax everything. Then the double taxation agreement will allow you to credit the tax in the first country against the tax in the country of residence. So even if you are not resident anywhere, the country of sources will still have the possibility to tax the income that arises there. So it's a very common misconception that if I'm not tax resident, I won't be taxed at all. But if you are employed in the country and paid by an employer in that country, even if you're working remotely from another country, if you've got a certain number of business days in the country where your employer is based, those business days will almost certainly be within the scope of taxation. So when you're choosing which residence by investment or citizenship by investment is right for you, there are multiple different criteria that come into effect. Firstly, if you're going to be living there, can you see yourself living there? Is it the type of lifestyle you want? Is it the kind of weather, the climate? Is it geographically convenient for where you might need to get to. If your kids are in university somewhere and you're sitting on the beach, what's the flying time? Do you want it too close or do you not want it close? The other criteria is what investments do you need to make? Some people love real estate investment and want to go somewhere where they can make their investment through buying a house or apartment. Other countries where they don't offer that, you have to make your investment into investment funds. Then some people are quite happy with that, and that's fine. Every single person will have the answer that's right for them. Every single country will have the type of people they're trying to attract, and putting those two together is an art, not a science, and you will often end up with different answers depending exactly where people are at that point in their life. So the first part of our job as investment migration advisors is to actually go through that decision criteria first, understand what people are looking for, help them filter out the places that they don't want to go, and only then narrow down on the 2 or 3 markets or countries where it's most attractive. Only after we've done that do we then look at the specific criteria for that country. But it's important to look at everything to rule out everywhere that you don't want to go as much as it is to choose somewhere that sounds nice, because there are a lot of different opportunities out there, and just focusing on one that sounds good may miss one that's even better. Simplest thing to do is talk to an experienced advisor, and they will find out what your needs are and then match that to the programs that are most appropriate for you. And then once you've done that, then we can look at the tax aspects as well and pull the whole thing together and work out what the right lifestyle choice is for the next years of your life. If you found this video useful and helpful and you want to talk to a real human being about this, then look out for henleyglobal.com, where you can find much more detail about all the different programs around the world. And there's also a link to the tax services page there as well if you want to follow up on tax issues specifically with me.